If you ask new investors what their biggest fear is, they will all tell you the exact same thing. I am terrified of picking the wrong stock and losing all my money in a market crash. They imagine the stock market as a casino where one bad decision wipes out years of hard work. Let me tell you a secret. The market does not destroy new investors with dramatic crashes. It destroys them through quiet, invisible mistakes that slowly bleed their wealth over time. In my experience, new investors consistently make 5 critical errors, and if you are not aware of them, you will probably make every single one of them. These errors don't feel dangerous in the moment, which is exactly why they're so expensive. Today, I want to show you exactly what these 5 mistakes are, the brutal math behind them, and the simple framework you can use to avoid them completely. But first, welcome back to Rebuild Finance. This channel is about documenting a long-term investing journey, building a portfolio step by step, and sharing the real analysis behind each decision. The goal is simple: find elite businesses, buy them at fair prices, and hold them for the long run. Now, let's dive into mistake number 1. Mistake number 1 is what I call the cash illusion, or simply waiting too long to start. Most people don't avoid investing because they are lazy. They avoid it because they think they are being responsible. They tell themselves, I will start investing when I have $10,000 saved up, or I will wait until I understand the market perfectly. So, they leave their money in a savings account thinking it is completely safe because the number on the screen never goes down. But this is a massive illusion. While you are waiting on the sidelines for the perfect moment, inflation is quietly stealing your purchasing power. Your money is not safe, it is slowly dying. And the real tragedy here isn't just inflation, it is the loss of the most powerful force in the financial universe, compound interest. Let me show you the brutal math. If you invest $500 a month at an 8% return starting at age 25, you will have roughly $1.7 million by age 65. But if you wait until you are 35 to start making that exact same investment, you will end up with only $750,000. Waiting just 10 years for the perfect time literally costs you more than $1 million. The market does not reward perfect knowledge. It rewards time in the market. Mistake number 2 happens as soon as people finally decide to invest. They immediately try to make up for lost time by chasing lottery tickets. Because new investors start late, they feel rushed. They look at the S&P 500 returning 8 or 10% a year and think, that is too slow. I need to get rich now. So what do? They ignore high-quality businesses. Instead, they buy the most hyped, speculative assets they can find. They buy penny stocks. They buy unproven crypto tokens. They buy unprofitable tech companies just because a guru on the internet told them it was going to the moon. They stop acting like business owners and start acting like gamblers. Here at Rebuild Finance, we look at things differently. When you buy a stock, you are not buying a ticker symbol on a screen. You are buying a fractional ownership stake in a real business. If a company is burning cash, if it has a terrible balance sheet, and if it has no competitive advantage, it is a bad investment, no matter how much hype surrounds it. Real wealth is not built by finding one stock that multiplies by 10 overnight. Real wealth is built by finding elite, cash-printing monopolies and letting them compound their earnings year after year. Stop chasing the lottery ticket and start buying the casino. This brings us to mistake number 3, which is a silent killer: ignoring fees and taxes. When new investors start, they usually focus 100% on their gross returns. They look at a mutual fund or an actively managed portfolio that promises a 12% return and they immediately sign up. What they fail to look at is the expense ratio. Let me explain why this is devastating. Imagine you are paying a financial advisor or a mutual fund a 2% management fee every year. 2% doesn't sound like a lot, but over a 30-year investing horizon, that tiny 2% fee will eat away nearly 40% of your total potential wealth. Let me repeat that. You are taking 100% of the risk, but the fund manager is keeping 40% of your final profit just for holding your money. This is why low-cost broad market index funds and ETFs are so powerful. By paying an expense ratio of 0.03% instead of 2%, you keep hundreds of thousands of dollars in your own pocket. And the same rule applies to taxes. Many new investors constantly buy and sell stocks, completely forgetting that every time they sell for a profit, they trigger a capital gains tax event. By constantly trading, you interrupt the compounding process and hand over a massive chunk of your wealth to the government. True wealth is built by holding high-quality assets for decades, allowing them to compound tax-free until you actually need the money. Mistake number 4 is misunderstanding diversification. Peter Lynch famously called this di-worsification. We have all been told the golden rule of investing: don't put all your eggs in one basket. And this is absolutely true. You need to diversify to protect yourself against catastrophic failure. But new investors often take this advice to the extreme. They buy a broad market ETF, which already contains 500 companies, but then they feel like they haven't done enough. So they buy 20 different individual stocks, 3 different sector ETFs, and bonds. They end up with a portfolio so diluted and messy that it is impossible to track. And worse, they end up holding shares in mediocre or bad businesses simply for the sake of being diversified. If you're buying individual stocks, you should only buy businesses that you deeply understand and that pass rigorous financial checks. If you find 5 or 10 elite businesses with incredible cash flows and impenetrable moats, why would you put your money into your 20th best idea? Warren Buffett said it best: diversification is protection against ignorance. It makes little sense if you know what you're doing. If you don't have the time to analyze balance sheets, that is completely fine. Just buy a simple, low-cost global ETF and let the market do the work. But do not buy 30 random stocks just to feel safe. Quality will always beat quantity. Finally, we arrive at mistake number 5, which is perhaps the most painful of all: panic selling high-quality assets. Let's say a new investor actually does everything right. They avoid the cash illusion. They buy high-quality companies with massive moats, like Amazon or Meta, and they keep their fees low. But then, the inevitable happens. The economy slows down, interest rates rise, or geopolitical tensions spike. The stock market drops by 15 or 20%. The new investor logs into their brokerage account, sees a sea of red, panics, and sells everything at the exact bottom of the market. They lock in their losses, vowing never to invest again. They fundamentally misunderstand how the stock market works. Volatility is not risk. Volatility is the price of admission you pay to get superior returns over the long term. If you own a business that generates billions of dollars in free cash flow, a 20% drop in the stock price does not mean the business is broken. It simply means the stock is on sale. When the market crashes, novice investors see danger. Professional investors see a massive discount. They do not sell their best assets when the market panics. They use the panic as an opportunity to buy more of those elite businesses at lower prices, which supercharges their compounding when the market eventually recovers. To summarize, if you want to succeed in the stock market, your strategy does not need to be complicated. You just need to avoid these 5 rookie traps. First, stop waiting for the perfect time and escape the cash illusion. Second, stop chasing speculative lottery tickets and start buying real businesses with strong cash flows. Third, protect your wealth by keeping your fees extremely low and minimizing your taxes. Fourth, avoid di-worsification. Focus on quality over quantity. And fifth, when the market inevitably crashes, do not panic, sell your best assets. Treat it as the buying opportunity of a lifetime. Investing is not about getting rich quickly. It is about building financial freedom slowly, logically, and consistently. It requires discipline, emotional control, and a solid understanding of fundamental business principles. Now, I want to hear from you. Which of these 5 mistakes have you made in the past? For me, it was definitely waiting too long to start because I thought I didn't have enough money. Let me know your experience in the comments below. If you found this video helpful and you appreciate this logical, numbers-based approach to investing, please hit the like button. It really helps the channel grow and reach more investors. And if you want to learn exactly how I analyze financial statements to find elite businesses, make sure you subscribe to the channel so you don't miss my future stock analysis videos. Thanks for watching, and I will see you in the next one.